Interest rates dropped again this week, but are they getting low enough to start turning our economy around? And what about all these mortgages that start renewing next year? How much of a payment increase are they facing after all these cuts? And ultimately, are homes starting to become affordable again? Well, we answer all those questions today. Plus, we have an update on the mortgage arrears data and how sales are trending in the month of December so far. Let's get started. Okay. You obviously heard it, especially if you were on social media this week, but the Bank of Canada lowered its overnight policy rate by 50 basis points for the second consecutive meeting, bringing it down from 3.75 down to a 3.25% overnight rate. This is a more than 2-year low for that rate, bringing it back to where rates were in September of 2022. So real quickly here, let's look at what that means for the size of mortgages that somebody qualifies for. Okay, and hypothetical here, this is a single person who makes $150,000 a year and has no debts. Okay, back when the overnight rate was 5%, that person would qualify for a mortgage of $700,000. Today, that same person qualifies for a mortgage of $850,000. That means after 175 basis points in cuts, the average person can now qualify for 21% higher mortgage or 21% more expensive home. So maybe if you were shopping back when rates were 5% and you were in the $1 million range, well, now you might be up to about the 1.2 range. That's sort of the difference that we are experiencing in the marketplace for people in their qualification levels. But let's move back into what happened with the BOC. The decision to cut 50 basis points was on the heels of some pretty weak economic data, including weaker than expected GDP growth in the second half of 2024. Plus, of course, 2025 GDP is estimated to be below the bank's forecast based on reductions in immigration levels, right? There's going to be no more falsely propped up GDP numbers when we're not bringing in 1 million, 1.2 million people per year into the country. And of course, the unemployment rate has ticked higher just last week alone as well. Of course, the looming potential tariffs, well, those are weighing on the decision as well, right? If these do come to be next in January, it's going to add a lot of uncertainty and potential push down on GDP growth as well. It is currently anticipated that the bank will cut down to either 2.5, maybe 2.75% in early to mid 2025. And then basically pause and let the sort of state of the economy kind of wash out and see where things go there. But you can expect maybe, based on today's economic data, to see a 2.5% overnight rate by the middle of next year. In the press release after the statement or after the release of the rate cut, Bank of Canada, I mean, they definitely feel like inflation is under control, kind of took a victory lap on that. And they definitely repeated the fact that it's at 2%. They've achieved it. Where it goes from here, we'll see, but they seem fairly confident in it remaining there. Keep in mind, though, core inflation still a bit sticky, right? It's at 2.5% and looks to be a challenge to get that down to the also desired 2% range. If you can believe it, the Bank of Canada also kind of came out and said, look, there's going to be no recession in 2025. Many think we're still in one today, but apparently we're not even getting into one next year. Again, it depends how you look at recessionary data, but that's the BOC stance. Moving forward with rate cuts, it looks like the days of the 50 bip cut are probably done, right? We had 2 in a row. Moving forward, they kind of alluded to the fact that we'll likely see just quarter point cuts as we work our way down to maybe that 2.5, 2.75 range. Yes, the Canadian dollar is getting hammered, and no, the Bank of Canada does not really seem to quote unquote care. Obviously, it's not a desired outcome, but it's not their mandate, right? So they know they have to sacrifice the Canadian dollar to get inflation under control and to basically get our economy back under control, get the jobs back into the marketplace. Do keep in mind too, yes, we obviously are focused on Canada versus US dollars, but look at what's going on with other denominations around the world, right? There's a lot of other currencies that are all suffering against the US. The US is just so incredibly strong right now. Everything's falling against it. So we're not the only ones suffering there because of lowering rates. A lot of other countries are feeling that same pain when it comes to the exchange. So we've been cutting a lot here in Canada, and the recent cut of where we are compared to where the States are, well, there's actually 150 basis point separation between our two countries right now. And the last time the gap was this big was 27 years ago in 1997. And interestingly, at that time, the USD compared to Canadian dollar is almost exactly the same as where it is today. But do expect that gap to widen. I do think as well, the Bank of Canada, they're doing their best to kind of hide or protect the average Canadian from how truly bad the economy is. And here's a few key points to consider as to why they cut 50 basis points and why we will see cuts at the next two meetings in 2025 and likely beyond that. Early last week, it was estimated that that cut was only going to be 25 basis points. I know myself and Ryan both predicted 25 bips, and we were both wrong. We both underestimated what the Bank of Canada was going to cut. But this was also an estimate based prior to the jobs report, which was not great, right? Jobs, while they did increase about 51,000 month over month compared to 25,000 that was expected, 45,000 of those, as in 80% of those jobs, came from the public sector. In fact, 45% of all new jobs created over the past 5 years came from the government. This is not a sign of a healthy economy, and it's not sustainable. Basically, after the jobs report came out, the chance of a 50 basis point cut went from a 10% chance to a 90% chance the day before the announcement. So the markets did get that one right. Now, the Fed budget is being released next week on the 16th, and it is forecasted to blow past their $40 billion deficit early projections, possibly by as much as 50% more. That would mean a $60 billion deficit. And I think it's reasonable to say or to think that we might start to see some job layoffs in the public sector. Speaking of jobs, the unemployment rate hit 6.8% this month, the highest in 8 years outside of the pandemic shutdown. That's definitely something that weighed into the BOC's decision. Canada now has 1.5 million people that are unemployed. That is up 22% year over year and includes 87,000 that were added last month alone. That is the highest monthly increase our country has seen since 2009. And it gets worse when we look at the number of workers unemployed for 6 months or more. That has ballooned from 150,000 in September of 2023 to 330,000 today, more than double in just 1 year. And the annual change in people unemployed for 1 year or more is up 90% year over year. So when people are unemployed for 2-3 months, they can typically find another job and start paying those bills again. But we're seeing people unemployed for longer and longer terms, 6 months, a year. That section of the workforce is where we're going to start to see some things really start to break. These numbers are so high. In fact, they've only been seen 4 times before, all 4 times associated with a recession. Not a vibe session, a recession. It didn't feel like these people were unemployed. They were unemployed. The implications of this level of unemployment is prevalent within the insolvency data as well. Consumer insolvencies up 15% year over year in Canada and up 25% in Ontario. That is the highest single month for insolvency filings that province has seen in 14 years. Right? You get an idea. These numbers are getting extreme here. Business insolvencies in the largest province of Ontario, well, they're not faring much better either. They hit 1,900 on a 12-month rolling basis. Nationally, that metric hit the highest we've seen since 2019. And Canadians who are restructuring their debt to make payments somewhat more manageable hit 10,000 last month. That number is the highest ever recorded. All right, that was a mouthful, but when you take all of these factors into consideration, you can see how it's possible for another 100 basis cuts or so to take place as we move forward into 2025.
Wow, you don't hear any of that on the news, Dan. And it's too bad because that's really the story that's taking place here. It's the things that we see on the ground. It's the stories we're hearing. It's, these people who are losing their jobs and stuff like that. Those are the people that we're helping sell their houses in instances, right? And we just don't hear it from our government the way we should, and for obvious reasons. But it's funny when the Bank of Canada says that there's no recession. Well, I mean, if you massage the CPI basket every time you need to fit the current narrative into the environment that you find yourself in, well, then, yeah, you might not ever find yourself into a recession. But that's just not the way this works. I mean, when you exclude the most volatile items, that we use every single day, I don't understand how we can continue to move the goalposts and expect things to work out. And the other thing that you mentioned there that really I think has huge weight is the economy strong enough to sustain the immigration cuts that are coming? I don't know, especially if you compound it with tariffs. It's going to get very, very interesting and very difficult for the government and Canadians, ultimately, who are really starting to feel the stress in our economy. It's showing up in the consumer confidence index, and it's rearing its ugly head. They reported the steepest 4-week decline in the metric since the BOC shocked everyone with a 100 basis point hike back in July of 2022. You got to understand, when this happens, this doesn't set the country up well in the near term. And this is exemplified in Toronto, where the unemployment rate has surged in November. Nearly 1 in 10 of the region's workers are simply out of work. They're not working. The unemployment rate there is now at levels not seen outside of the deepest recessions. Yet we're not in a recession yet, and we're not headed towards one. But yet we have these metrics. With the jobless rate hitting pandemic levels, the unemployment rate in Toronto alone rose 24% month over month and is up 47% year over year. These numbers are absolutely absurd, especially when you consider the government is the number one employer right now. Only the first 3 months of the pandemic have recorded larger monthly increases than this, right? A global problem. New housing starts are dropping fast as well, with 9% of Canada's workforce employed in this sector. You could expect unemployment levels to rise even further, especially before they turn around. And here's the thing that kind of bugs me. The BOC is saying, well, we're not going to be in a recession next year. And yet we're seeing all these indicators that are leading us towards that. Housing in Toronto, though, at least told a little bit different story. It seems to have broken a little bit of its trend. Sales were up a mere 2% month over month, but up significantly, 39% year over year, and up 50% for detached homes. Prices rose too, though albeit quite mildly at 0.8%. But that is the largest single increase in the last 17 months. It's quite possibly an outlier because 1 month does not make a trend, so we'll keep an eye on this. But we need really the numbers for December before we can do that. If so, we'll know if it's an anomaly or has, a better outcome hit with Toronto at the cycle bottom. It's really tough to say right now, especially when you consider what's taking place throughout the greater economy. I'm just not convinced that if people are losing their jobs and we continue to cut rates, that people are still going to be buying houses at accelerated rates or for more money if they're not making any. It's kind of the cart before the horse sort of thing.
It's really fascinating to keep studying this data that seems to be so polarizing, where you've got intense consumer and business insolvencies on one side and stable housing on the other. And the stable housing just kind of is like echoing and repeating here. And there's new data that kind of supports this further. I mean, it's the arrears data, right? We bring this information to you every single month. And well, the December data is out. What do you think? Did arrears go up, down? Actually, it did nothing. It stayed the same at 0.2%. And it's been at 0.2% for 3 months now. And just in case you don't know, to be considered in arrears, that means somebody has not paid their mortgage for 3 months or more. Ontario, good old Ontario, is obviously seeing the brunt of a lot of this non-session that we're in, apparently. They did see a bit of an increase at 0.01% and is now at 0.17%, tied for the lowest nationally alongside British Columbia and Quebec. So we're over 2.5 years now of higher interest rates. And the arrears rate, which bottomed out in mid-2022 at 0.14%, has now hit 0.2%. And a constant reminder here that was at 0.25% pre-pandemic. So we're still below that sort of long-term average when it comes to arrears. The last time interest rates were at 3.25%, where we are today, was 2009 during the global financial crisis. Pre-pandemic, of course. Arrears rate at that time was 0.45%, a number that we have not seen since. It's been below that ever since the GFC. Now, I've been very vocal about my stance here for about the last year and a half that Canada will not experience a mortgage renewal cliff, and so far the data supports this. Of course, the next 2 years will be the most telling. But consider this single fact. Most mortgages renew after a 5-year term, right? That's pretty typical. The average price of a home in Canada is up 57% over the past 5 years. With equity comes solutions for that homeowner. We would obviously be in a very different position or situation if homes had dropped 57% in value over those same 5 years. But they haven't. Okay, the average Canadian home has gone from $456,000 up to $717,000, creating an average of over $250,000 in equity. And so for homeowners that are struggling to make monthly mortgage payments, well, they have equity, so they have solutions or options. And that includes, of course, re-amortizing or sell and buy something more affordable. I want to quickly explore re-amortization so you start to get an understanding of the numbers and the likelihood of future arrears not spiking. Okay, so that home purchased in 2019 for $456,000, let's say 10% down with a fixed 5-year term. That's back when the overnight rate was 1.75, so you could get a mortgage around 2.5% fixed with a payment of $1,900 a month. Okay, so it's 5 years later now, and the rates are where they are. Okay, so the balance of their mortgage has gone from about $423K down to $358K because they were fixed and they were paying down principal. That current home, though, like I said, is now worth $717,000, creating 50% equity in that property. Renewed today, fixed term, that payment is $2,200. Okay, so they would get a payment shock of their mortgage at 16% higher. But let's say that's unmanageable and they need a solution. And so they decided, well, what happens if we re-amortize? Now, keep in mind that previous mortgage was insured, so they were at 25 years. They've paid down 5 years, they have 20 remaining, but they're going to re-am to 30 years based on today's rates, which are obviously higher. So you now get a mortgage rate at about 4.49%, 45%. Remember, they were 2.5 before, so they're up a full 200 bips. But their mortgage payment, now that it's a 30-year AM, is $1,804. It's 4% lower than their previous. And yes, I understand they have re-am to 30 years, which is absolutely not great for some people. And it's just an option that I want to share and needs to be carefully understood and examined if it's something that you want to consider. But again, when it comes to keeping somebody in that home, it's an example of one solution that people can explore.
Bend and defend. Heard
That's
the term
our
before. It was very common back in the pandemic. One thing I did want to mention, just as a thought process here, just based on what you were saying there, Dan, my thought process as to why arrears are on the stable side of things is because as of the third quarter in 2024, Canada's household savings rate was at 7.1%. That's a 3-year high. And that's up 6.2% from the second quarter of 2024. And I was asking myself, well, why is this the case? And I truly believe it's because Canadians do not trust the government. They don't trust where things are going. They don't know where things are going. So they are hoarding their cash and making sure they can cover their own expenses, as much of them as they can. That's kind of my thought pattern around it. And what's more, affordability, I mean, let's touch on it. It's far from great, but it does seem to be showing some signs of improving. The monthly mortgage required to buy a typical home in Vancouver is currently at $4,800 a month. Now, that's way up from 2021, which was about $2,600. But it's a solid improvement of about 19% down from $5,700, which was what it was at its high in 2023. Rental rates are continuing to lower as well. Rents dropped 0.9% month over month and 3% year over year in November. This drop affected the monthly condo cash flow index, which has been steadily rising since 2023 and saw its first monthly drop in 12 months. So that said, let's move on to some pre-sale data in Toronto, because this is still terrifying. Sales are down 84% year over year, and they're down 66% compared to 2023, with just over 100,000 homes under construction in the area. Supply looks to remain high for the coming years. But with new construction at almost a standstill and building permits having dropped like a stone, When we hit 2026 and onwards, I think the narrative could change here.
What a polarizing world we're living in, hey, Ryan, where it's like we're hitting almost record credit card total debt amounts, consumer insolvencies, business insolvencies, and yet housing is starting to trend at least towards more affordable. Dangerous statement, but you get the idea here. So we're just seeing, again, the economic divide is widening, and it's going to be a very interesting 2025. But we will, of course, make our predictions as we do every year, and share what our 2024 predictions turned out, how right and how wrong we were with each one. But just the last little bit here, wanted to touch on a mini market update as to what's happening in December, because as always, it is interesting. So in the first 11 days of this month, we saw 817 homes sell. And compared to last year, 54% higher in sales. So if you remember, October was higher than the previous year, November was higher than the previous year, and December is well on its way to also see higher sales than last year. So you're seeing a bit of a trend then. Don't get me wrong, still below long-term averages, but we're starting to tick up. And with prices, if you remember last month in November, both average and median prices ticked up. Both this month so far, they're each up about 20K as well. So interesting shift in the marketplace. All this data is, of course, prior to the rate cut, and we will see how much that takes hold into the rest of this year. And ultimately, does this kind of set us up for an early spring market, right? Don't forget, we've also got a rate cut at the end of January that, as of today, definitely looks like a 25 bip cut. So much can happen between now and then, and we'll keep you updated. But as of now, interesting setup for the new year. Those who can't afford to move, looks like they might be doing something next year and expect to see elevated sales compared to last year. But let's not get ahead of ourselves. We will let the numbers wash out as they will and update you accordingly. So thank you, as always, for tuning in. Have an awesome weekend. Oh, and real quick here, we released a bonus episode just this week on Thursday. It is dedicated for homeowners that would like to explore the concept of having a builder build multiplex for them and sell the units to basically net them, well, maybe as much as $1 million more. It's a fascinating episode, and you can get in and explore this project opportunity with no financial outlay. There's $0 you would have to input here, basically. So check out that video as well. Thanks as always. We'll see you here next week.